Olympic Games, high-speed railways, never-ending construction projects, world-dominating manufacturing powerhouses. As they emerge from periods of decline, China and Japan have been on similar paths of economic development. Though the changes have taken place 50 years apart, many economists are now seeing parallels between the bursting of Japan's bubble in the 1990s and the growing economic woes seen in China today. So just how crazy was Japan's bubble economy? And is China going to be another Japan? To answer these questions, we must go back in time to Japan in 1946. World War II had just ended, and Allied air raids including 2 atomic bombings left Japan in ruins. The US-led Allies dismantled many pre-war Japanese business conglomerates known as daibatsu, which were the core of the country's war machine. Bureaucrats in Tokyo were forced to start again from scratch, and the government started prioritizing resources to rebuild raw material industries. Steel, coal and textiles operations received government loans and subsidies. Then in the late 1940s and 50s, the onset of the Cold War and the Korean War flooded Japan with economic aid and military orders from the United States. These factors paved the way for Japan's economy to go through exponential growth in the years that followed. From 1960 to 1976, Japan's GDP grew from 44 billion US dollars to more than 580 billion US dollars. In 1968, Japan emerged as the world's second largest free market economy, behind only the United States. Over the next decade, Japanese car makers such as Toyota and Honda went on to beat US car makers by supplying affordable, well-built cars. And electronic brands like Sony and Panasonic became symbols of innovation worldwide. America's trade deficit with Japan increased from 15.1 billion US dollars in 1982 to 58 billion US dollars in 1986, or 1/3 of the overall US deficit. US leaders made clear they did not like it, through a response much like what China will hear decades later.
Our patience with unfair trade isn't endless, and we're taking action to bring other nations back in line to ensure that free trade remains fair trade. We're aggressively using existing trade laws to pry open foreign markets and force others to play by the rules. This week, for instance, we signed a breakthrough trade agreement that'll open up Japanese markets to U.S. semiconductors and prevent the Japanese from dumping semiconductors in our markets.
Finally, in 1985, Japan's leaders agreed to allow the yen to appreciate against the US dollar. The Plaza Accord, reached at a trade summit in New York's Plaza Hotel, left Americans hoping that maybe, just maybe, a weaker dollar would make US goods sell better overseas. While that didn't happen, the deal did trigger an exceptionally large appreciation of the yen, a 46% rise against the dollar by the end of 1986. A more expensive yen was not good news for Japan's export sector. To stimulate the economy, the interest rate was dropped from 5% in 1985 to about 2.5% in 1989. The government also introduced a 43 billion US dollars stimulus package in 1987. So, what happens when you pour that much money into the economy? Television ads for an energy drink reflected the brash confidence many felt about Japan's economy. Banks were eager to lend money to pretty much everyone, and borrowers used the funds to purchase more land, which was then used to secure more loans from the banks. By 1986, land prices in Japan had increased by as much as 5,000% from what they were 30 years earlier. At the peak of the bubble economy, Tokyo real estate was selling for as much as $139,000 per square foot, nearly 350 times as much as it costs in New York's Manhattan. By that reckoning, Tokyo's Imperial Palace was, at the time, worth as much as the entire US state of California. Japan's buying frenzy was also seen overseas. In 1987, a Japanese insurance company bought Vincent van Gogh's sunflowers for $80 million and showed the painting to the royal family. The Mitsubishi Group bought New York's Rockefeller Center in 1989. That same year, Japan's Sony acquired American film production company Columbia Pictures. It wasn't just the Japanese who wanted a piece of the action. Just look at this advertisement from the South China Morning Post in 1989. It said a $5,000 investment in the fund in 1986 would have grown to more than $58,000 by 1989. Those prospects would only look better since the Nikkei index rose to almost 39,000 later that month. Some investors argued that Japan's stock price was so high it was almost in outer space. One Japanese stockbroker joked, Newton's law of gravity doesn't exist in Japan's stock market. About 30 years later, when the Shanghai Stock Index jumped in 2015 to about 5,000, the Chinese Communist Party mouthpiece People's Daily announced that a bull run had begun. The newspaper said China has no tradition of bubbles or even dynamics to make one. Of course, when stock markets keep rising, such remarks seem to reflect human nature. And unfortunately, Newton's law did eventually pay a visit to the Japanese market. Enter Yasushi Mieino, the new governor of the Bank of Japan. When Mieino took office in 1989, he sensed that Japan's economic growth was unsustainable. What did he do? He poured buckets of iced water on the red-hot iron that was the Japanese economy. Japan's central bank boosted the interest rate all the way from 2.5% in 1987 to 6% in 1990. Stocks and real estate went into a tailspin. Japanese companies, banks and individuals soon found themselves drowning in bad debts because the properties they held were worth just a fraction of what they cost to buy. Companies and banks went bankrupt. Consumers didn't want to spend. More people lost their jobs. The suicide rate went up. The government tried to stimulate the economy by investing in infrastructure. But since many essential roads and bridges had been built decades earlier, stimulus often gave rise to roads and bridges to nowhere, as well as debts and government deficits. In short, Japan has spent the last 3 decades trying to shake off a post-bubble hangover. But as one country licked its economic wounds, another star was rising on the world stage. It is the well-known tale of China and its economic miracle sparked by a reform and opening up policy introduced in December 1978. And on the surface at least, stories about China's boom times bear some resemblance to what was seen in Japan. Chinese companies had started to snap up overseas assets such as Swedish car maker Volvo. The US, meanwhile, soon grew unhappy about its trade deficit with China and Beijing's hefty subsidies in the manufacturing industry. More recently, bilateral relationships became mired in a bitter trade war. There have also been ups and downs in the Chinese economy, but the Beijing government has been swift and calculating in dealing with them. When the 2008 global financial crisis threatened to derail the Chinese economy, which depended heavily on its export sector, China rolled out a 4 trillion yuan stimulus package to jumpstart the economy. And it worked. The country's GDP growth soon returned to double-digit levels. And remember the 2015 China stock market rally we mentioned earlier? The bubble did burst in the end, but unlike what happened in Japan, Beijing authorities rolled out a slew of support measures. Interest rates were cut, and officials mobilized brokerages, asset management companies, public pension funds, and even the central bank to give the market more ammunition. That's not to say there were no problems. China has been relying on the real estate sector and government spending on infrastructure to generate substantial economic growth, but the industry and local governments have racked up substantial debts that pose risk to the overall Chinese economy. The government tried to defuse the threat by introducing a free red lines policy. It tightened funding conditions for 12 major property developers and set caps on the amount of debts they could hold in relation to cash on hand, the value of their assets, and as a proportion of equity in their businesses. The central government has also promoted programs like loan restructuring to help reduce the burden on local governments. Beijing has also punished officials for seriously affecting the effectiveness of the prevention and resolution of hidden debt risks. Despite all the apparent problems in the economy, Chinese authorities insist they remain in control. So why are people asking, is China becoming another Japan?
Weaker economic data in China again.
The housing market in China just continued to get worse.
Zero
and even
COVID rebound doesn't look as though it has a whole lot of momentum.
Accumulation of $12.8 trillion of debt.
The news headlines coming out from China these days mirror what Japan saw as its woes deepened in the 1990s. The world has high hopes for a post-COVID rebound after the lifting of harsh lockdown measures at the end of 2022. Though China's GDP expanded 3%, the nation still missed its official target of around 5.5%. And the country's recent economic figures have been worrying. Compared to the first quarter of 2023, China's GDP rose by only 0.8%, down from a rise of 2.2% in the first 3 months of the year. That reignited concern that China's debt problems and bursting of the real estate bubble would trigger a Japan-style recession. But some experts believe that China and Japan's economies are not a good comparison.
中国现在面临的是一个新旧动能转换过程当中面临的一些问题，所以跟日本当年房地产泡沫破灭之后，整个经济出现了几乎所有这种主体的资产负债表衰退，包括经济的这种大幅下滑，还是有本质的区别。我现在整体的这个企业投资和这个产业投资的一些情况来看，那么新兴产业的这个投资，这种行业发展速度远远超过这个市场预期。但是呢，一些传统的行业，包括一些传统的领域，确实遇到了很大的这种挑战。
Chinese economists suggest that there is still untapped potential in China's service sectors that could generate growth. Although many sectors of China's economy were open for private investment, service sectors, including medicine, telecoms, education, and finance, still have relatively high barriers for entry.
其实服务领域当中的这些投资也好，消费也好，是中国未来增长的一个比较大的一个动能和潜力。那如果我们未来在围绕重点的服务领域当中，我们去降低市场准入的壁垒，比如说我们扩大我们在很多领域当中的这个外资的准入，那实际上就能够进一步的激发我们的市场的动能和潜力。
Western economists are less optimistic about China's future growth potential, but they were also on board with the idea that a robust private sector could be the real game changer for getting China's economy bouncing back.
And if economics worked according to that kind of theory, then nobody would be poor, right? So Africa would be really rich because they have so much development potential. You can achieve very good things in engineering and science, but really what you need is the boring bits of the economy, like retail, wholesale, distribution, transportation. The boring bits of the economy have to thrive as well as the sexy bits of the economy. And to do that, you really need to have very, very strong private sector, very, very strong institutions like, good regulation, rule of law, strong competition policy. You have to attack concentrations of wealth. You should not tolerate high levels of inequality.
It seems clear that China's leaders are determined not to let the country go down the same path as Japan. But Beijing cannot go back to the old path of fueling growth through real estate and infrastructure investments. Institutions like the World Bank have said China's old growth model has largely reached its limits. The country, they said, must shift its economic structures from manufacturing to high-value services and from investment to consumption. The Chinese government has introduced policies to stimulate the economy, such as easing mortgage rules for home buyers and cutting interest rates. The National Development and Reform Commission also introduced a plan focused on reducing business costs for goods and services in hopes of triggering more spending. But it said little about raising income and employment levels. Finding a way to put the nation back on a path towards development will be a touchstone to judge the wisdom and resolve of China's leaders.